On this podcast, we're going to be talking to a very popular economic figure, Harry Dent. Before we get into that episode, make sure you book that onboarding call with myself so we can get to know each other better. If you've checked out some of the old coaching calls, it's a little bit preview what you can expect. I know a lot of you guys are introverted like myself, a little bit shy, but go ahead and book that call. I'll be nice. Passionate about this stuff because it changed my life when I started to invest in real estate back in 2009. You can join the club and book a call with us. Shoot us an email, team@thewealthelevator.com. Super excited to meet all you new folks coming into the group these days. We also released that tax masterclass. A lot of people are looking to sell investments and offset that capital gain and depreciation recapture. 8 ways to do it in this masterclass. You can access that at thewealthelevator.com/tax is the form there. But if you're already a investor with us and you're logged in, you can access that in the e-course section. Enjoy the show. All right, welcome everybody to the show. Today we have a special guest, Harry Dent Jr., who is known for bold predictions and deep insights into market cycles. If you're just getting started investing in real estate, have some rental properties, or accredited investors investing in syndications, private placements, and private equity, and you're looking to deepen your understanding on macroeconomics, today's podcast is going to be giving you a lot of insights. He's written the book Zero Hour, which you can pick up on Amazon. He's a seasoned market analyst and has spent decades studying the patterns that drives these boom and bust cycles, which in commercial real estate, we've definitely seen the boom and the bust. Here to share his unique takes on the economy. Welcome, Harry. Thanks for jumping on.
Nice to be back, Wayne.
Let's start off with everybody on the same page, right? Like present day, maybe step up to speed on what's happened after COVID, and we'll get into what's happening today.
Normally my news is, well, here's the fundamental trends. Here's what the baby boomers are doing, millennials. None of that matters. This is all stimulus, okay? The story, and it's an unfortunate one from my point of view, the overreaction, I call it, to COVID. COVID was a natural crisis. These things happen. We had influenza from 1918 to 20, same 2-year thing, and then it disappeared. That's what they do. Everybody gets it, and then it stops and disappears. So why would you stimulate? I counted it up, $11 trillion combined fiscal deficits and monetary injections in the economy. $11 trillion in 2 years out of $27 trillion since the 2008-9 crisis, which they overreacted. They meant to print $1 trillion in the US and something similar in Europe. They thought $1 trillion each ought to solve this short-term crisis. No, they ended up printing $27 trillion in the US alone between money printing and massive deficits. And 7% of that's been the biggest string of deficits in US history. There has not been a balanced budget surplus since 2001. We overreacted to COVID, 11 trillion stimulus. And what does that force you to do? We get 9.1% inflation. I've been forecasting this for decades, that we would go down to 1 to 2% inflation. We go into a very low inflation economy with a boom with the millennials, starting from 2024 to 2037. And of course, we saw the baby boom. But the real truth is we should have been in a long slump, just like 1930 to 42 in between generations, and 1969 to 82. Those were 2 times when the economy grew slower. One of them was a deflationary downturn, which we get every other time, and the other one was an inflationary in the 70s, the greatest inflation in all of history, and also the greatest depression and greatest deflation in history too. So very extreme century we had. They overreact. And that meant they had to then over tighten 525 basis points between March 22 and July 23. The problem with that, and people know this, but they still don't think this way and actually project it out. It takes about a year and a half for that to hit the economy most fully, and it may be taking longer now with such large stimulus. But with the 1.5-year lag I use, we're going to feel this the most around the end of January next year. So early next year, for the next 6 months, we should be feeling it hitting harder. And everybody's saying, oh, economy's doing fine. We haven't seen a recession. First of all, we already fell in a recession and didn't know it. I think that may be the case here to some degree. But the point is stocks are priced for perfection right now. Perfect soft landing. There has never been a perfect soft landing. 1995 might have been, and I don't know why 95 was seen to be a slowdown, because it wasn't in retrospect. And there was no demographic dip. There was nothing that would cause a downturn. The middle of each decade is usually the strongest, not the weakest. The first 2 to 3 years in most decades that we get recessions. So whatever. So that's what we've had. An over stimulus, now an over tightening, and people acting, yeah, the economy's fine. I will judge it 6 months from now. We'll see how fine the economy is in January. I think it's going to hit harder than people think. And that means the stock market is way behind the curve here. And the Fed is way behind the curve here. They're not going to ease until later this month. And they're going to probably go a quarter of a basis point. I think stocks are going to be going down. So I'm telling investors, hey, be cautious here. It's a time to get in safer stocks or get in treasury bonds. We're going to have a slowdown. There's one thing that goes up at a slowdown. It's AAA corporates, but better the treasury bonds, because they will not default no matter what. They can't and won't. So they are the safe haven. And you got people like Peter Schiff saying the same story I am. After it's stimulus, he says we're going to have runaway inflation, but he sees gold as a safe haven. I will tell you that ain't going to happen. And all you have to do is look back at 2008. I call this 2008 times 1.5. That this recession should be 1.5 times harder, 80 some percent down instead of 50 some percent, and 1.5 times longer, like more like 2.5 years instead of 1.5 years. So this is going to be the deepest recession we see, more like the early 80s, more like 29 to 32, I think. Now, we'll have to see what the government does, but you have to realize they've already blown their wad. They've gone beyond stimulus already and then had to correct that. It's going to be hard for them to flip right back this quick and get aggressive fast enough. So I think they are going to continue to be behind the curve. So be cautious until we see reasons otherwise. I'm talking big crash, not 20, 30%. The people who do see, oh, we're probably due for a correction, because we are. Anybody with any brains, Lane, is common sense. This is the longest in the history of the entire stock market since the late 1700s on without a recession. Recessions are not a bad thing. People don't understand them. They're like sleep. They say, hey, people, we got to stop sleeping. Sleeping is a waste of time. No, sleeping is restorative, repairs and maintenance. It's important. If you don't sleep for just 3 days, people go crazy. We need recessions, and we usually get one about once every decade. And this is 15 years, the longest ever. So most people will say, oh, it's long time, long boom. If we do have a slowdown, it'll be a mild one. No, the longer you go without cleaning house, the more you got to clean your house.
From a business owner's perspective, we talk about this in my board advisors groups. People need jobs. We just came out of a period where people were ghosting job interviews. There are plentiful jobs, and now things are turning underneath the covers.
Yeah.
Where you need that dynamic. And essentially that's what drives inflation is wages. People are finding plentiful, high-paying jobs, or at least they were.
Yeah. Inflation is usually the thing that ends most booms, at least in this modern era where inflation has been an important trend. If you look back in the 1800s, there was hardly any inflation in the whole century. This inflation is for a reason. This is a demographic thing. Between immigration and births, the baby boom was a surprise, the biggest thing to happen in a long time. And of course, I'm a demographics guy. I've always studied demographics beyond economics. And I was the first one to see this back in the early mid 80s. I was lecturing to small businesses at Vistage, the executive committee.
Yeah, that's what I'm in. We're speaking from the same
the most fun thing. That was the best thing I ever did. Did all the groups, even in Australia and England and stuff and all. But I was telling people, like, guys, we're going to have the greatest boom in history. People are like, what? The Japanese are eating their lunch. What do you mean, Harry? We're has-beens. We're losing one industry after the next. And I'm saying, no, we're losing the old, less profitable, standardized industries, not the new customized and high-tech ones. We lead those, and we still lead those. And that's how this boom has happened. The baby boom with our lead in the tech and more customized industries and trends in the world, which is the big trend in the developed world. But that came to an end in 2007. Since 2007, again, we should have had a long, and I mean like a 1930s, like long slowdown, more like the 30s than the 70s, deflationary, high unemployment, and we just skipped over it. They just printed their way through. And 27 trillion is a lot. That's 1.5 times our average GDP over that period. 1.5 times we poured in to an economy. And that alone, if you add the fiscal and the monetary, would have been about 9% of GDP per year. And we should have been growing at 8 to 10% with that much stimulus. And we've been growing at 2% adjusted for inflation. That massive amount of stimulus didn't produce much. That we're overexpanded. We finally hit a slowdown, which is way overdue. Right now, 2024 is the year when I would have originally projected that the millennial generation would start their spending wave, which is rising from 2024 into 2037 approximately, and then it plateaus into the 2050s. So it doesn't go down like past downturns, it just plateaus and goes sideways. So that's what we should have, but we're going to have the depression or the downturn we didn't have, and we're going to have to clear out a lot of. And this is what happens, Lane. What happens in a downturn, we wipe out the weak companies, the zombie companies, which is a healthy thing, like losing fat or getting toxins out of your body when you get a cold. Colds are actually a healthy thing. Flus are different. Flus invade you and basically attack you. Colds, 9 out of 10 colds, are your body saying, I need to cleanse. I need to eliminate some excess. It's a good thing. It keeps us healthy. So do recessions. If you don't want a bad recession, don't have a bubbly boom with a lot of bad debts. Don't let borrowing get out of control, which it always does in booms. The booms are driven by businesses investing to meet rising consumer demand. You have to have rising consumer demand. Businesses have to invest to meet that. When they make these investments through equity and debt, they're going to make some bad investments. Everybody does. People make mistakes, and that's how we learn. But mistakes aren't a bad thing either. That's how we learn. That's what recessions do. They cleanse out those investments that aren't paying off and clear up capital, go back into productive investment. It makes these recessions about 2 to 3 years every 10 years. Oh, guess what? That's the same ratio, about 30% that we sleep versus waking. We sleep 30% so we can be strong when we're awake. We have recessions about 33 out of 10 years every decade. What do we start this boom with? 1980s. Okay. 80 through 82, 3 years were recessionary. And then the next 7 years, 83 to 89, we're boom. That's what happens. That's a typical decade. And we had a 3-year downturn, 2000, 2002. On it. People don't respect the natural cycles. And especially, I make fun, okay, partly because it's funny when I'm giving speeches. I make fun of economists, say that people never had sex or run a business. And they haven't. They don't look like they've had sex. And I have never met an economist that's run a business. There may be a few somewhere. I have not met one. And I've never met anyone that's met one. So how do you understand the economy? The people I used to lecture to with you in tech, they're the people who understand the economy, especially large businesses. I consulted first few years the large businesses at Bain & Company and worked in large businesses at first. They're detached. Most people in that large business don't ever see a consumer. Only the people in the front lines do. When I used to do turnaround work at Bain & Company and in large corporations, the first thing we do is talk to the secretaries in the back office, not the executives, and talk to the frontline sales and service people. They're the people that understand what the hell's going on. And that's the way it is. Recessions are a good thing up to a point. And economists so misunderstand the economy. Now they're going to create an artificial recession because they didn't have a natural one. And this is going to only be worse because we put it off 4.5 years. This recession should have come and would naturally have come between late 2019 and late 2022. Most stock crashes throughout history come in the first 3 years of every decade. It's another predictable thing that most economists don't have a clue on, and it happens almost every decade.
Yeah. I think we've seen real estate, financial sector get hurt the first, right? It's like a train wreck. Most people fixate on their stocks, essentially just Nvidia and Tesla and those Apple, the top 5, 6 stocks out there. I think that's, again, echoing what you're saying.
Exactly what happens at the top of a bubble. The people, the dumb money are piling in. Everyday people are finally piling in. And what do they buy? The most visible companies like Apple and Microsoft. That's what they buy because that's what they know and see. They say, yeah, I'll just buy Apple. So they all buy the same stocks. Those stocks get particularly overvalued and you get narrowing breadth. Fewer and fewer companies are accounting for more and more of the gains in the stock market, which is also the sign that you're going to have a crash every time. So all the signs are there. The only difference is we skipped over the decennial cycle, so we're going to have it on a lag. Other than that, all the signs are there. And most people, don't have a clue. Go watch CNBC. I have it on the background every day. Okay. I don't hear hardly anybody warning about a recession. Jeremy Grantham was couching it at 50% stock correction. First of all, when you have a major downturn, it's not 50%. Okay. You either have 20% kind of normal, healthy corrections, or you have these 70 to 80% big downturns like we had in the 70s and early 30s and early 80s and all. So that's another thing. Everybody always, if they do finally accept we're going to have a slowdown, they always have the softest version of it in the predictions. And that's what almost never happens.
So you talk a lot about demographics, which a lot of people get lost in, like what's happening on the week to week. Interest rates are coming down, but maybe talk a little bit about the big factors like demographics, baby boomers, millennials, to break that down. You touched about it earlier, but
Yeah.
you can break
Well,
that down
yeah.
for our folks.
What's really important, and this has never happened in our history, we're not growing. I came up with this way back in the early 80s. The most important fact about economics that economists never talk about: when we spend money, we enter the workforce at age 20. That's when we start spending, and we spend until age 46, now moving towards 47. Very predictable thing. So when I take the birth index, and I have to adjust for immigrants, which is the only difficult part, but I can do it accurately. I just moved forward the immigration adjusted birth index for 46 years. And now in the future with the millennial generation, 47 years. And it tells me exactly when the economy is going to boom and bust, decades in advance. We should have had, and we did have a great boom from 1983 to 2007. That was a natural, healthy boom driven by the biggest generation in history. So it was the greatest boom in history, as I predicted in the early 80s. And I got more guff and criticism back then for being overly bullish. I said it one day and everybody liked it so much. Dow of 10,000 by 2000. That wasn't the peak of the boom in 2007, but I was just saying back there in the 80s, by 2000, the Dow was going to be at 10,000 when it was at 2000 when I was giving these talks. Okay. And people thought, oh my God, Harry, that'll never happen in our aging, slowing economy. The Dow got to 12,800. So it went substantially higher. My overly bullish forecast, even for the people who liked me and thought I was pretty much, they still thought I was over forecasting. We had the great boom. The downturn, the baby bust hits 2008 to 2022, 23, depending on when that lag shifts to 47.
Let me ask, it's not necessarily population. Population is staying the same.
Right.
In fact, maybe even growing, but it's that spending years is what you're fixating on.
It's the waves, the generational waves coming into their peak spending on a 46, 47-year life.
Yeah.
Simplest indicator
I mean,
ever.
see, one of the big things is, yeah, population is increasing, but this bifurcation of the rich and poor is creating what you're talking about. It's
Right.
the average or median, however
Right.
you want to
And
call
there's
it.
two ways to increase population: births and immigration. Where we have historically been strong on both. Our births are now slowing down. So the real big picture, though, for generations is we're in a long plateau. The peak in births was 2007, and then it went down into 2022, 23, and then the millennial boom takes us back up to the same level, 4.3 million births in 2037. So we're not going to new highs. The next generation is not taking us to substantial new highs like every generation has done throughout history, particularly the baby boom generation. So we are a maturing nation, and it's not us, the entire developed world. The only places that are going to continue to grow are small countries in Scandinavia, Norway, Sweden, Finland, and Australia, New Zealand. Australia is the strongest of those five. Australia is just like us. They don't have many more babies than we do, with a white toast population, okay, of basically British people, much more than the US. They have very strong, high educated Asian immigration. They have the best immigrants in the world. Nobody complains about Asian immigrants. Yeah, huh?
They pay their rent.
Yeah, they're hard workers. Yeah, they have strong work ethic, highly educated. They value education. The 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 funniest thing in China, everybody's waiting for them to lift the one-child policy. They finally did, and guess what? Chinese are not having two children or three. They want to have one and get them into Harvard or Stanford. Very strong emphasis on getting their kids a strong education. So they are the best immigrants in the world, and we're the country that most gets them. Australia gets them on a higher percentage rate, but of course we get much higher numbers because we're a much larger country. So Australia, New Zealand, US, and Canada are the big beneficiaries of Asian immigration. And that's what's kept us strong. And then what do most voters in the country want to do? Oh, we want to slow down this immigration because they're competing for our jobs. No, they're the people bringing us growth when we otherwise would be slowing because are aging and we are having few kids like all affluent people. Affluence kills birth rates. It just does more in the West than it does in the East.
And that's the aging population of Europe. Unless you're old
Yeah,
money living in old Birmingham, you're fourth, fifth, sixth generation in, you're being surpassed
yeah,
monetarily.
and that's a great. I'm glad you brought that up because Europe is a bifocal. Northern Europe is more like the United States. It's got mildly bullish demographics for a while before it really slowed. Southern Europe is East Asia. It's just like a death spiral. They're aging rapidly. So Southern Europe and East Asia is China, even though they're emerging country, and usually emerging countries have very strong demographics. China is going to lose 40% of its population in the next 50 years. That's going to be drastic. And the biggest thing that's happened in history, Japan and South Korea and Taiwan, 4 countries are aging rapidly. And Southern Europe, which is basically Italy, Greece, and those countries along the Mediterranean, those are also slowing very
Yeah.
rapidly.
So for clarification, you talked about Europe. Which of the northern or southern has that lazier come for old money, but eventually losing it mindset?
The most innovative and dynamic economy is Great Britain and Ireland. Okay. They are more like they're the closest thing to the United States. Strong entrepreneur. I worked in Switzerland for a summer and spent a good bit of time in France. French are not entrepreneurial. They are not innovative. All they trash progress. They hate progress. They like the good old days and they like to make of their own wine and all this stupid stuff. Okay. And that's fine. They make grow good food, but they're not dynamic. The dynamics come
Yeah.
from Scandinavia, Great Britain, Denmark, Northern Europe, and Germany, not France and not Southern Europe along the
Yeah.
Mediterranean.
That's the old money and where
Yeah,
America's
well, yeah,
coming there.
and that's the people retire. They really retire. They really don't. They never work another hour the rest of their life. They just drink their wine and sit in the sun in the Mediterranean. Big difference between Northern and Southern Europe. I always analyze and project them separately. Northern Europe act like the United States and Canada.
Unless you have immigration coming into those countries, somebody's got to pick up the broom, engineer or do something to power
Right.
their economy along.
Exactly. And guess who doesn't have immigration? East Asia has no immigration and they're totally against it. Japan has a very homogeneous culture. People like that. They're happy when everybody fits in because they actually do. But it does not favor immigrants, innovation, and a dynamic economy, and it doesn't favor growth. And those people are not having immigrants. And South Korea and Japan have the lowest birth rates in the world, and China is very close to them. And again, that's rare that an emerging country, China is still a second world country, not a third world, but they're still a second world country. Normally, those have higher birth rates because they have affluent people. Affluent is what kills the birth cycle. Affluent
Education.
people have fewer kids because they want them to get a better education. That's what drives affluent people. And that's why East Asia, they have that same ethic. They value education for their kids and have fewer of them on purpose. Like you say, they live the one child policy and they might as well not have. There hasn't been any noticeable bump in higher birth rates. So nobody's going to 2 or 3 kids. Very few people are doing it. Developed countries and affluent people choose to have fewer kids. And it's great for them. It's just not good for the economy.
Yeah. As a Japanese person, fourth generation, I'm still waiting for my invitation back into the country. Maybe because we fought against them in the war. But what's going to happen in Japan? They're holding on to their anti-immigration policy. Choke
They've
on
been
it.
stimulating. They're the most indebted country in the world by a mile because they've had to keep stimulating their economy and adding more debt in an aging country. Aging countries usually have less debt because older people pay off their mortgage and most of their debts and don't borrow. It's young people that borrow. Most of the borrowing's done between age 20 and 42 in the housing cycle, trading up from a starter home to your biggest home, which is normally done by age 42. But Japan, the government's just stimulating. I think older people must be spending more money on cars and travel and vacations or something because Their spending has gone beyond what they normally would do. But Japan their economy is just going to keep slowing forever. It never turns around. And China's the same. China already peaked in 2011. I can get that one down to the year because I got better statistics on China, on births and stuff. And they just go down. You can check 2060s, they're still going down. They don't ever turn around because neither country has immigrants. Nobody's going to immigrate to China, and Japan doesn't allow, but it's a great standard and quality of life over there. And that's one reason they guard it, but it's a dying country. Japan is never going to grow again, demographic. They're doing nothing to stop the slide. Immigration, again, since they've already proven that even when you lift in China, you lift the one child policy and you encourage births, they don't have them anyway. So immigration really is the only solution in Asia. And Japan has said, one day I think China would allow immigration if people wanted to come. Nobody's knocking on the door in China because it's poorer than most. People don't move from richer countries to poorer ones. They move from poorer ones to richer ones. That's obvious. And so China doesn't get that, but China keeps getting wealthy in Asia. They may become a magnet from immigration from Southeast Asia, which has strong demographics. When I look out at the future and look out to 2050s and 60s, and I go out that far all the time because I can project out that far. And the growth in India is going to be the next China. India in the next 4 decades is going to do what China did from the early 80s until recently. 2000, the biggest growth story in history. And it was driven by the same thing that has driven the last century or two, urbanization. Economists don't get this either, Lane. Demographics and generations form these larger groups of people who learn together and earn and spend and do all these things together, change and innovate together. Long term, we have these bigger cycles of countries emerging and becoming urban and wealthier, 3, 4, 5 times as wealthy. That's huge. That's the biggest thing that happened in the United States. It took us 160 years to fully urbanize and get to the highest standard of living in the world, or one of them. But you got countries doing that now in 2 to 3 decades. And Korea's doing the same thing as Japan on a 30-year lag. Same thing, and becoming rich and going from a third world country to a first world country in 3 decades, and going from 20% urban to 8 to 90% urban. In those countries, they get up to 92. The US petered out around 80-ish. Most countries in Europe, 80-ish. Some of the Scandinavian countries go higher, but generally 80 is about, somebody's got to still be in the countryside producing raw materials and food. And so that usually comes out to about 20% can do that with modern technology. You want to meet rich people? The richest people I've met are these farmers in Iowa that own thousands of acres and have giant $1 million combines. Each one of those is a $1 million machine minimum. These are rich. The richest people I give lectures to is these farmers in the middle of nowhere because they dominate their area. There is no little house on the prairie in Iowa. Giant combines and farms.
So we went around the world a little bit. Maybe let's bring it back to America. Would you agree with the United States is the prettiest girl at the ugly girl dance when you compare it with other countries out there? And
I call it the best house in a bad neighborhood. We have a real estate bubble. We already had the first one burst, 2006 to 2012. The rest of the world didn't. Australia never had a burst. Our real estate is not as bubbly as Australia and Northern Europe. So they're going to have a bigger crash than we have, and they're going to have it. It's going to take many years, and they're going to have that in the next 4 to 6 years or however long it takes. It's probably going to take that long. So stocks only took about a couple of years to crash, and it took 3 years in 2000, 2002, but real estate took 6 years to hit bottom and turn back up again, and never got as strong as it did. But we have a second bubble now, and this bubble's much longer and much bigger. Nobody sees a bubble this time. This is a bigger bubble. All you got to do is look at this fact. People look at BS and not facts. All I look at is facts and real people doing real things. Anybody says this isn't a bubble is deaf, dumb, and blind. The biggest real estate and biggest bubble ever in history. And we'll never see one this big again because nobody will allow this to happen after this one burst so bad.
how do you bifurcate residential? Residential has stayed high. Commercial real estate has come down quite a bit.
Commercial real estate almost always goes down first because it feels the economy and the impact of slowing generations of economy is slowing long term and will continue to. There may be special places that are growing, but we don't ever need to build another office or house again. We have enough to house and office and work environments for all the people we will ever need, for the millennial generation, the Z's after them, the Y's after them, and everybody else. This is a first. We've never had a time where we've actually matured demographically and plateaued for a long period of time. The plateau for America is 2007 to 2037. After 2037, we just go down like Southern Europe is already doing today and East Asia is already doing today. There's no end to their decline so far. No end I can project to Southern Europe or to East Asia. And there'll be no end I can project. So far, the downturn after the millennial generation will continue into the 2050 and maybe 2060s.
And
So
that's where
the
I see like houses, people can't afford that. But if I look at Europe and Asia, it's apartments, lower level housing.
people have gotten this thing that housing does nothing to go up. It's the best way to get rich. Housing's going to go nowhere for long. I'm predicting into 2030s and even more so after that, but at least out to 2037, where I can predict more accurately, we will never see house prices this high in America again. Certainly not 2037. So the millennials are not going to see the same appreciation and stuff in housing. Now, if we have a good bust, then they'll be able to buy at reasonable price. The winners out of this housing bust are clearly the millennial generation and people after them, the Y's and Z's and whatever they call them. The losers clearly are me and baby boomers, okay? The people who now own all the houses, who are now in their 70s, 60s, 70s, and 80s, and they're downsizing or at best staying in the house they had, even though they got a bunch of empty homes, hoping their kids may come back to visit them sometime, and they don't. We've never seen this before. We've always grown, always needed more. Housing's always gone up, been the best investment. The best investment in the future is going to be emerging country stock market. People in developed countries are going to have to invest in India to make money, because our stock market's going to go nowhere for decades.
Yeah.
And the degree they do go somewhere is going to be global corporations, which most of the Fortune 100 are, the S&P 500 and Dow and stuff. Global corporations that are growing in Asia.
To leave people with more actionable advice here, a lot of what you're saying is more long-term macro trends. Makes a lot of sense. But what is a guy, a couple million net worth? He can't just put his money in T-bills. He's got to grow his money
No,
more.
exactly.
What is he doing?
The thing about a bubble burst, because this is and it's accurately called an everything bubble now, okay? It's a bubble in everything. Stocks, small cap, large cap, foreign, everywhere. Even gold. Peter Schiff's telling people to buy gold. Gold's a bigger bubble than the stock market. I'm telling you, gold's going to go down to $1,100. That's the only anybody looking at a chart that didn't know what that chart was. Any chartist would look at that chart and say, "Oh, okay, we're in a fifth wave peak, and we're going to go back down to the fourth wave, and that is 1,100 on gold." That's not as bad as the stock market going down 80%, but even gold's going to go down. So there's nowhere to hide. Like what you do only for a couple of years. And people say, "Larry, I can't do this forever." I'm not telling you to do this forever. I'm saying for the next 2, maybe 3 years max, you get in the one investment that goes straight up, particularly in the economy it's at its worst, 10 and 30-year treasury bonds, the safest bonds on earth. But then people say, "Oh, but our government's in too much debt. Oh, the government's going to have deficit." Yeah, but we're the best house in a bad neighborhood, as I said earlier. And look at 2008. We had the deepest recession since the Great Depression in the early 80s, okay? What happened? Our bonds went up 45% when stocks went down 57, 58%. This time I'm saying stocks will go down 86% at the most. And I think that's where they're going to go, though. It's the most, but it's all for the S&P 500, 93% for the NASDAQ approximately. And bonds are going to double. So average 20-year treasury bonds is going to go from 95-ish today to 186. It's going to double. Imagine doubling your money. So you're flush with cash and you sell those bonds at twice what you bought them for. It's better than that. You know how many people will do that? Probably 1%.
What if you are the 1% and you do that? Maybe not with all your portfolio, but a nice, good position. At what point do you re-enter the market at that point?
You enter it when it's down 80 to 90%. That's what a downturn like that. You're not looking for a 50% crash. as even Jeremy Grantham and a lot of other bearish economists are looking for. They're going to start telling people to buy at 50. Here's another thing people don't get about bear markets. The more they go down, the more they go down. When you're down 80% and you're down to just 20% of your money and it goes down another 10% from 80 to 90, you just lost 50% on that 20%. Okay? You just lost another 50% from where you already beaten down. So you have to take this seriously. Most financial advisors, and I'm telling you, I love financial advisors. I used to primarily work with financial advisors. That was my biggest market in the 90s. Mutual fund companies using me to speak to financial advisors, tell people to pour money in mutual funds because of this long bloom. This is the one time where you have to get out of risk assets, all risk assets, and get into these high quality, safe haven bonds. Only them and the highest like AA, AAA corporates actually appreciate when this happens because the money goes there because it is the safest place you can be without going into T-bills and making 4%.
Yeah.
That's going to go down. You know what T-bills when inflation went down to 0.4% in the 2008 downturn and they stopped it. That would have gotten worse. It would have gone another year and we would have had deflation. You're going to see rates go down to the lowest levels. And that's why these long-term bonds, when you lock in, let's say a 4.5% treasury bond today, 10-30 year, if rates go down to zero or negative this time, those bonds paying you 4.5% are going to look like gold. They're going to be golden. That's why they appreciate so much. You've got high rates when you can't get them anymore. So those bonds are worth, literally, they went up almost 50% in 2008. They're going to pretty much double or more this time around. You'll never see that happen again in history where the safest, lowest risk long-term investments, treasury bonds, go up more than anything else and go up that much in a short period of time. Never see that again. And I'm telling you, 99% of people are not going to see this coming and not going to react and not going to do the simplest thing they could do to double their wealth in a downturn. And that doubling wealth is more than doubling because you get to buy everything 80, 70, 60, 80, 90% off with that inflated money. So it's
Yeah.
really worth 3-4x.
Before I let you go, a lot of us investors are more alternative investors. Say they do listen to you and take a chunk out of their 401k, out of the traditional investments. What are some alternative investments that you're interested in? I know you mentioned demographics, so that's assisted living, nursing homes that we play
Yes.
around with. And then you also mentioned international India stocks. How would you play that or any other alternative investment? Just throwing out there lightning round style.
The millennials and the younger people are going to need apartments again. So you can buy apartments if you need income in retirement. And that's a lot better. You can buy the long-term bonds because they give you income and appreciate for a while, but you're going to have to sell those. When you want to sell those treasury bonds, let's say in 2027 would be my guess today, you buy apartment buildings. Real estate, apartment buildings will hold up a lot better than normal real estate, but it'll still be cheap. You're going to have strong rentals. You're going to buy cheap and have strong rental income for the next boom to replace what you now can't get in bonds anymore because bond rates are going to go down and they're just going to stay down. My indicator, the same indicators that predicted to me all the way back in the early 80s that we would have 1 to 2% in the 90s and 2000s, say we're going to have that same environment, very low inflation for as far out as the eye can see. It'd be very slow workforce growth. Economists have no clue. There's only one thing that generates and correlates with inflation, and it's workforce growth because we have to expand. When workforce is growing, you have to expand all the infrastructures, including all the education they get before they enter the office buildings and all the training. It takes an investment. That's how you make money in booms. Even when people aren't needing houses, millennials are just buying baby boom homes, not having to build them like we did. We had to build homes for the baby. So when they're not building houses, you can make money in rental real estate and things like that. And nursing homes is the bomb. That's a whole industry, and managing old people ain't easy. As long as you can get somebody to do that and not have to deal with that, there's no better demographic than nursing homes in real estate because the baby boomers are going to drive that straight up into the 2042. Be the
Yeah.
biggest bull market in real estate in the developed world.
We just got presented a deal with built to rent stuff, which I'm not a big fan of because it's just too expensive to maintain. That's why we like apartments. But If I'm taking your notes here, you're saying that because even though population might be going up, these guys can't afford houses and they're going to need these lower level housing solutions such as apartments. So maybe people build these built to rents, but ain't nobody's going to buy them. It's just going to be forever a rental.
Yeah, that's right. People generally rent until most people can't afford to buy until about 26 to 28. That's when people in normal times, now you have to be 56 to afford a home because it's so expensive. Literally, that's what the latest statistic. It's somebody, only 56-year-olds can afford to buy a house that would suit them, a nice trade up kind of long-term greatest home. Age 56 to afford that now. It used to be 42 for that trade up home, but that will change. Housing will come down. And again, as I said earlier, the biggest winners will be these millennials and younger people. And the losers will be the baby boomers. And some people in high end areas, vacation areas are going to lose a lot more than that. You're going to see some homes go down 60, 70, 80%. That is devastating, especially when you have a mortgage against it and the mortgage doesn't go down. At some point, banks will probably be forced and the government will be giving banks incentives like tax write-offs to write down loans because these loans will not be sustainable if housing falls. So
Yeah.
that'll be another big mess. But the best thing is just don't get in that mess. If you don't own the house, then you can buy at what I call the sale of a lifetime. Real estate is going to be the biggest sale we'll ever see in our lifetimes. The real opportunity here is real estate. Stocks crash more often. A real estate crash of this magnitude is literally once in a lifetime. We did not even have one anywhere near this magnitude in the 1930s because real estate was too hard to borrow. The loans were hard to get in the roaring 20s. It was 50% down, 5-year terms. That was your typical mortgage loan. And so most people couldn't afford one, couldn't qualify. Most people couldn't speculate on that. It's like they can today. Now you can borrow 100% or 10 or 20% down at most, and it's easy to speculate. Some people have 2 or 3 homes. 2 of them are just for renting out. A lot of people in China have extra homes, 2 homes. A lot of people have 2 extra homes and they don't even rent them out. They just say, this is the thing that goes up and we're going to get rich on real estate. I'm telling you, China is going to get the biggest shock of any country in the world if I'm half right in the next several years. People there have 75% of their net worth in real estate. We have more like 50% in the US, and that's high. Normally it's 20 to 30 is what it should be. So this is going to be devastating, but boy, Asia and particularly China, I'm mourning China in advance. I know how difficult that's going to be.
Yeah.
And how much they value real estate and have staked everything on this one asset is just going to crush them.
What's your thoughts on buying businesses from baby boomers retiring, private
Absolutely.
equity?
That's another great opportunity. You look for businesses, baby boomers who grew their business and now they're in their 60s or 70s, and they either need to do it part-time or need to sell it and have somebody take it over. You buy into that when it's cheap. Businesses are definitely going to be on sale just like everything else. Real estate's obvious. Stocks are obvious. You see them go down on the TV every day. You know what's happening. Most people don't see that, yes, businesses will be on sale and you're going to be able to buy something for 20 cents on the dollar, just like you can be able to buy stocks for 20 cents on the dollar. You can buy businesses on a similar ratio. And that's something you can be active in. A lot of aging baby boomers would like to have a business they could run out of their home in their retirement. Nobody wants to sit around and play golf like the Bob Hope generation did. That would be a death sentence to me. You have to pay me to play golf like a professional. And I'm not a professional. Golf is insulting. I don't see it as fun. It's a hard sport unless you play it regularly. So this is going to be a big shift. And again, nobody's saying we never seen an aging crisis. It's an opportunity in a lot of ways, especially if you're in the nursing home business and assisted living. But it is a major change in our demographic makeup to go from younger generations. All emerging countries are young, but developed countries were young up until recently, and we're getting old at the speed of light, particularly East Asia, Northern Europe, and North America.
Thanks, Harry, for jumping on. I appreciate it. If people want to get more acclimated with your content, how can they find you?
0 hour is really dated, but it still has the basic theory and all that sort of stuff. Although the best thing to do is get on my newsletter because it's current and I'm always updating on demographic there, but also on all the indicators of the economy. That's how you get to know us. And hopefully some percentage of people decide to get our newsletter. You just go to harrydent.com.
All right. Thanks, Harry, for joining us. All right, that's the show. A little bit of recap. Harry's one of these guys who always take notes on some things I take with a grain of salt. If I'm looking down my notes here, the big ones are like the demographics. A lot of that is undeniable. Like you said, office, especially with the long-term trends, we reached a peak of absorption at this point. He's talking about real estate in terms of housing stock, which from 2022 to 2024, we haven't really seen any type of correction there, like how we've seen 20 to 30% in commercial real estate. So definitely a bifurcation between those two. Part of that is a lot of people are in their houses with really sweet mortgages and they don't want to get off of it. Obviously, we would argue that if it's a good return on equity, but that's not how most people think out there. So they're going to probably stay put in their houses. But this has created a low supply, and that has obviously kept prices up because it's a supply and demand dynamic. That said, American population is keeps going up, especially because we are the place to be. Like you said at the top, immigration is coming in. Those people are obviously replacing the lazier people in the workforce, but it's going to take a couple of generations for that to play out. But what we do know is that people are going to be able to afford houses less and less. That's why I fall back on apartments, lower middle class housing. If you look at Europe and Asia, they don't really live in houses. They live in closer quarter apartments because cost per unit is a lot cheaper and it's a lot more value for the majority of the population. I just want to offer a counterpoint. A lot of these folks, they'll say broken clock is right twice a day, as they say. A lot of these folks like to sell newsletters and are always going off of the economy is going to crash. Obviously, we talked about none of this is financial advice, but we talked about taking chips off the table on the traditional side. But who knows if that happens, right? I think what we've seen, and I would urge people take a look at some of the content by Richard Duncan. We've detached ourselves from reality and we're in this artificial world where the Fed, United States can just print money. Not saying it's right, but that's what it is. And this could detach us off normal market cycles. So do keep that in mind. Everything Harry says is correct, but it may not always play out that way. And you could miss out on the best bull cycle. Always take this stuff with a grain of salt in terms of where's the information coming from and who's it's predicated towards. If you're somebody who's not yet to end game, 3, 4, $5 million, I still think you have to invest in assets to get going. There's always going to be a element of risk there. But yeah, sure, if you've got a lot of money and you don't really need to grow it anymore, then just put it under the bed, under the mattress, dig a hole or do some T-bills. Ultimately your money's going to be going down in terms of inflation, but have the ability to play that game. Two different points. And that's why I say, see where you fall on the floors of the wealth elevator. Pick up the book. You can find it on Amazon, The Wealth Elevator. And if you guys want to get a conversation going here in the comments of the YouTube section, let us know. Also, if you guys haven't yet joined our group, thewealthelevator.com/club, and we'll see you guys on the next podcast. Bye.